Something strange happens at the exact moment a market feels the most frightening. The screen is bleeding red, the headlines are shouting that it is over, and every instinct you have is telling you to get out before it gets worse. And right there, in that ugliest possible moment, a certain kind of money quietly does the opposite. It steps in and buys. Not because those buyers are braver than you, because they have seen this movie before and they know what the panic actually is. If you are holding silver right now, watching it get cut down, feeling that cold knot in your stomach that makes you want to just be done with it, I want you to slow down for a few minutes before you do anything you cannot undo. Because the crash you are looking at and the fear you are feeling may not be the warning you think it is. It may be the signal. And the people who understand that are the ones the big banks and the financial channels would rather you never listen to. By the end of this, you are going to understand why the scariest tape is so often the exact moment the informed money is buying with both hands. Here is the first thing almost nobody points out when metal is falling. When a real panic hits the financial system, silver and gold do not always drop because people have decided they are worthless. They drop at first because they are among the few things you can actually sell. Think about that. In a full-blown scare, half of what people own becomes impossible to move. Nobody wants the risky stuff, the leveraged stuff, the illiquid stuff. But gold and silver? There is always a bid. So the frightened, the over-leveraged, the funds getting margin calls, they sell what they can, not what they want to. And what they can sell is the metal. It gets sold precisely because it is good, not because it is bad. That is one of the most important and least understood facts in all of investing. And once you see it, you cannot unsee it. I lived through the last time this happened at scale, and I want to walk you through it, because it is the whole spine of this story. Go back to the financial crisis, the one where the banks nearly took the entire system down with them. In the very worst of that storm, gold did not soar the way people assume a safe haven should. It got sold. Hard. It fell right alongside everything else for a stretch, and the financial press had a field day with it. See, they said, it is not even a safe haven. It goes down with the stock market. Look at it. And a lot of ordinary savers, good people who had done the responsible thing and bought some insurance, looked at that falling number and lost their nerve and sold right at the bottom, right when it hurt the most. Now here is what those people did not understand, and what the desks selling that story understood perfectly well. Gold was not falling in the crisis because gold had failed. It was falling because it worked. It was the fire extinguisher that still had value when the house was burning, so it was the thing people grabbed and sold to raise cash. The liquidity that makes it precious in a panic is the exact same liquidity that makes it the first thing dumped in a panic. And once that forced selling burned itself out, once the margin calls were met and the weak hands were gone, do you know what gold did? It did not just recover. It roughly tripled over the next few years onto record highs. The terrifying tape was the buy signal. The panic was the entry. And the people who understood the mechanism were on the other side of every one of those frightened sell orders. That is the pattern I need you to hold in your mind as we look at silver today. Because silver is the same story with the volume turned up. Silver is a smaller, thinner, wilder market than gold, which means when the forced selling comes, it falls further and faster. It overshoots. It gets ugly in a way that makes gold look calm by comparison. And that ugliness is exactly what convinces regular people it is broken, right at the moment it is going on sale. The move that scares the retail holder out is the same move that brings the informed buyer in. Two people looking at the identical screen, feeling two completely opposite things. One sees a disaster. The other sees a discount with an expiration date. And let me be blunt about who profits from you feeling the disaster. When you panic sell metal into a shakeout, you are not selling into a vacuum. Somebody is buying what you are dumping at the price your fear set. The trading desks, the bullion banks, the same institutions that write the research notes telling you the metal is dead money. They make their living on exactly this churn. A frightened retiree unloading real metal into the low of a washout is not a victim of the market. He is a customer of it. And the silence about how this actually works, the way nobody on the mainstream financial channels will ever sit you down and explain the liquidity mechanism I just explained to you, that silence is not an accident. It is the business model. Now, before I go any further, I want to pause for a moment, because this is exactly the point where I owe you something practical, not just a story. If you are 55 or older and you have $100,000 or more sitting in a 401k or an IRA, there is something happening at the very top of the financial world that you deserve to know about because it bears directly on everything I'm telling you. The largest, most informed buyers on the planet, the central banks, the national institutions that manage entire countries' reserves, have been buying gold at a pace we have not seen in generations. For 3 straight years, they bought at a record clip, roughly double what they averaged the decade before. These are the ultimate insiders, and they are not chasing a rally. They are quietly accumulating the exact asset we are talking about. Here is the part almost nobody tells the ordinary saver. There is a perfectly legal, perfectly ordinary way for you to do the very same thing inside the retirement account you already have. You can move a portion of that 401k or IRA into physical gold and silver, real metal, held for you, without triggering taxes and without triggering early withdrawal penalties, using what is called a self-directed precious metals IRA. This is not some exotic loophole for the wealthy and the connected. If you have $100,000 or more in any retirement account, this is available to you. The same tool the big institutions use, scaled to your kitchen table. I put together a free retirement protection guide that walks through exactly how it works, step by step, in plain English. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing, and there is no obligation. Now let me get right back to it because the story gets more interesting. Let me stack another piece of evidence on the pile because I do not want you taking any of this on faith. Think about how quickly a safe number can move when the machinery decides it should. Not many years ago, the exchanges that govern this market raised the cost of holding a silver position several times in a very short window, and silver fell around 30% in a matter of days. Nothing about the actual metal changed. Not the supply, not the industrial demand, not one physical fact about silver on planet Earth. What changed was a rule, a margin requirement, a lever pulled by the people who run the paper side of this market. That is how much of what you see on the screen is mechanics, not merit. The price can be shoved around by the plumbing, and the frightened holder never knows the difference between a real collapse in value and a temporary squeeze on the leveraged players. And that leads to the deepest part of this, the part I promised you at the start, the part the financial channels will simply never walk you through. There are 2 silver markets, not one. There is the paper market, an enormous tower of contracts and claims and promises, where far more silver is bought and sold on screens than actually exists in any vault. And then there is the physical market, the real metal, the coins and the bars you can hold in your hand. In calm times, those 2 markets move together, and you would never know they were different. But in a true stress event, they split. The paper price, driven by forced selling and margin calls and leveraged funds bailing out, can crash. And at the very same moment, the real, physical metal can become nearly impossible to actually buy, with premiums jumping and dealers running dry. The screen says silver is cheap. The real world says silver is scarce. Both can be true at once, and that gap, that impossible-looking gap, is the informed money's favorite thing in the world. We watched a version of this happen not long ago. In one of the sharpest scares of recent memory, silver crashed toward the low double digits in a matter of weeks, an absolutely violent stomach-turning drop, the kind that makes every headline scream that the metal is finished. And then, within months, it more than doubled off that low. The ratio between gold and silver, which measures how cheap one is against the other, spiked to a historic extreme at the bottom, screaming that silver was as undervalued relative to gold as it had been in living memory, and then it snapped back hard as silver came roaring back. The people who bought the terror were rewarded. The people who sold the terror funded the reward. Same tape. Opposite outcomes. Now, here is the midpoint turn, the thing that actually separates a crash worth buying from a crash worth fearing, because I do not want you to think I am telling you every dip is a gift. It is not. So how do you tell the difference? You look at what the smart, patient, informed money is doing while everyone else panics. If the crash were real, if silver were genuinely being abandoned as a store of value, you would see the deep-pocketed buyers heading for the exits right alongside the crowd. You would see the central banks selling. You would see the long-term accumulators giving up. But that is not what is happening. It is the opposite. The biggest buyers on earth are stepping up, not stepping back. And that single fact tells you the falling number is a liquidity event, a fear event, a mechanical event, and not a referendum on whether metal is still money. Look at the bigger backdrop those informed buyers are staring at. Gold recently passed a milestone that should be on every front page and is on almost none. It overtook a major world currency to become the second largest reserve asset held by central banks anywhere on Earth, sitting behind only the US dollar itself, the first time that has been true in a generation. Why are the most sophisticated financial institutions in the world quietly reordering the foundation of the global system toward metal? Part of the answer is something that happened when one major power had its foreign reserves frozen by others, overnight, with the flick of a pen. Every central bank on the planet watched that and drew the same conclusion. Gold sitting in your own vault cannot be frozen, cannot be sanctioned, cannot be turned off by a decision made in another country's capital. It is the one reserve asset that is truly yours. And they are voting for it with real money right now while the crowd argues about a short-term dip. There is another tell buried in the last couple of years that ought to make you sit up. For most of modern history, gold moved inversely to interest rates. When real yields rose, gold was supposed to fall, and it reliably did. That relationship, the one every textbook and every trading desk relied on, has quietly broken. In recent years, gold has climbed even as those yields stayed high, doing something it was not supposed to be able to do. Why? Because the buyer who now sets the price at the margin is no longer the yield-chasing fund. It is the central bank, buying physical metal for reasons that have nothing to do with this month's interest rate. The old rules that the financial channels still recite to you are describing a market that no longer exists, and they either do not realize it or do not want to say it. This is the recognition moment, and I want you to really sit with it, because it is the whole point. The informed money already sees what I have just shown you. The central banks are already positioned. The patient accumulators are already buying the fear. But the mainstream, the pension funds, the financial media, the neighbor who asks you why on earth you would own metal in a world of screens and apps, they have not caught on yet. Not even close. There is no mania here. There is no line around the block at the coin shop, no cab driver giving you silver tips, none of the euphoria that marks a real top. What there is, instead, is quiet, informed accumulation happening underneath a wall of public fear. And that is exactly what the early part of a great move looks like. By the time it becomes obvious to everyone, by the time it leads every news segment and every advisor at every firm is recommending it, the easy part of the move will already be behind us. That is the nature of this. Nobody sends you an invitation. Nobody calls your house to tell you the moment has arrived. By the time the crowd is sure, the discount is gone. So let me be honest with you about what this is and what it is not, because you will never hear that honesty from someone selling you certainty. I cannot tell you what silver will do next week or next month. I cannot promise you a price or a date. Silver is volatile. It is thin, it whips around, and it can absolutely go lower before it goes higher. And anyone who tells you they know exactly where the bottom is guessing or lying. This is a case built on history and mechanics and the behavior of the most informed buyers alive. It is not a guarantee, and it is not personal financial advice for your specific situation. What I am asking you to do is not to gamble. It is the opposite. It is to stop letting a mechanical, fear-driven tape scare you out of an asset that the smartest money on earth is quietly buying. And that brings me to what you should actually think about doing with your own position, in plain and practical terms. First, if you are going to own this, own the real metal, or own it in a form where actual physical metal is held for you, not a paper promise that can evaporate in exactly the stress event where you need it most. Second, size it so that a shakeout can never force your hand. The people who get destroyed in metal are almost never the ones who bought too little. They are the ones who bought with money they could not afford to see fall, so when the mechanical drop came, they were forced to sell at the worst possible moment, funding somebody else's discount. Own an amount you can hold through the ugly stretch without flinching. And third, do not sell into the shakeout. That is the single most expensive mistake ordinary savers make, over and over, generation after generation, and it is the one this entire video is built to help you avoid. If you have watched this far, you are exactly the person I made this for, and I want to offer you one more thing. For those of you with $100,000 or more in a 401k or an IRA, I am opening up a small number of free one-on-one educational web conferences. No cost, no pressure, no sales pitch dressed up as help. Just a real conversation about your specific situation, how the precious metals IRA actually works for someone in your position, and whether it even makes sense for you, because sometimes it will not, and I will tell you that too. Here is the honest reason to do it now rather than later. The right time to make a calm, unhurried decision is precisely when nothing feels like an emergency, when the crowd is bored and afraid and looking the other way. Once metal is on every front page, the calm window is gone and every decision is made in a rush. Right now, it is quiet. That is the gift. If you are on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com and mention that you watched this all the way through. So did silver crash? Yes, it did, and it may not be finished. But go back to where we started, to that ugly, red, terrifying tape in the last great financial panic, when gold was sold because it worked, and the frightened funded the patient, and the metal went on to triple while the sellers watched from the sidelines. The scariest tape is so often the exact moment the informed money is buying, not because they are braver than you, but because they understand what the fear actually is. You are looking at that same tape right now. The only question left is which side of it you want to be on. The big banks already know their answer. Now you know it too.